Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Like the name suggests, this show gets you actionable insight on everything mutual funds. And we are anticipating that the monthly numbers for the month of August for mutual funds and the mutual fund industry is going to be released very shortly. We will take you through the cliff notes and the key highlights and also the interpretation of those numbers. In the meanwhile, let's talk about the topic that I've chosen for today. And it's not something we speak of very often for very good reason. We're talking about credit risk funds today. They've gotten a bit of a bad name for very good reasons. As I mentioned, there was a major incident in the form of the Franklin Templeton issue that some of you will be aware of. And since that time, you've had a very sharp decline over a period of time in the assets under management in this particular category. What is it all about? What should you do? And is there a moment, if not now, then in the near future, to relook at this category? Devang Shah, who's head of fixed income at Axis Mutual Fund, is joining me at the start of this conversation. Devang, thanks so much for taking the time. And I was just talking to my viewers about credit risk funds, and this is essentially a product, a fixed income product in the mutual funds landscape that is supposed to give them better yields than they would get on government paper, but at the same time they would have to take a little bit of credit risk, the risk of a default by an issuer or a company. Do you think that the scenario has changed materially since we saw the major drawdowns and since we saw that major crisis? We've seen a very big reduction in the assets under management, but has the scenario changed?
Thanks, Alex, and thanks for bringing out this topic. I think probably you rightly highlighted about how the overall industry has significantly undergone a change over the last so many years. And how do we advise credit funds? I think probably we look across at 2 to 3 important aspects while deciding whether you should allocate to credit, first of all. I think first, always we should focus on what's the economic cycle, like how is the economic cycle going across in the country? How is the external situation looking across? Are there any vulnerabilities which can lead to a significant slowdown or a recession kind of an environment in your economy? At this point of time, when we look across at the macro picture in India, I think obviously it comes out to be very, very strong. And on all the 3 fronts, we are in a situation where it's a golden period for India, where you have a relatively strong growth to the rest of the world. You have a very, very stable external environment thanks to the entire buildup of FX reserves. And lastly, if you look across at the inflation cycle, it is actually going lower. And we are seeing the inflation trending significantly lower thanks to lower commodity prices, thanks to the pain in China, and many other reasons. So from a macro point of view, I think the growth outlook continues to remain supportive and strong, which is a very, very strong positive cushion for credit cycle. The second thing, while analyzing credit funds, I think you should always focus on how the credit spreads are in the economy. When you're looking at, you, as you pointed out, you are getting an extra spread over government bonds, and whether those spreads are attractive from past trends, whether they actually are good enough from a macro cycle perspective. Today, if I look across at AA and below rated papers, their spreads are good enough to invest. So AA spreads today are trading at somewhere between 75 to 100 basis over AAA. And if you go slightly lower the curve and you invest in a single A paper, the single A issuers are issuing in the band of 200 to 250 basis over AAAs. So these spreads, if I look at the history and some trend, these are good enough from an investment perspective. So yes, when I look across from a macro perspective, definitely both the growth cycle as well as the spread, which are very good determining factors for selection of credit, at this point of time looks neutral to positive.
Devang, just on the subject of credit risk funds, it has been argued in the past that these funds give you slightly better than average fixed income returns, potentially, but you have to take on the equity risk in a company. And that's simply because if the company is going to go bust, ultimately it's going to be unable to pay the debt, and that has occurred in the past. Would you agree with that statement, or would you have a differing view?
So I would say it's not completely correct, Alex. You're right to a certain extent that in the past cycle we have seen some drawdowns where people have taken large hits on credit portfolios. But when we talk about the overall mutual fund surface, and probably when we look at the credit spectrum in India, even in 2020, I think largely, if you look across at all the portfolios, they were invested in double A's and single A's. A large portfolio percentage was still invested in double A. When you look at the PD, the probability of default for all these categories has been quite minimal. And I'm talking about larger timeframes of history, and in a good economic cycle, actually, you see a significant lower probability of default. But to come to your specific question, does a credit risk fund underlying papers deal exactly similar to an equity? I would say it depends on the underlying structuring, how you have invested into a bond, what kind of governance you have put across. Yes, there if you are doing it like an unsecured lending to a corporate, probably the end result might turn out to be like an equity investor where there can be significant drawdown. But after the entire crisis and I think probably how the industry has evolved over years, a lot of structuring goes across. There are a lot of optionalities being put across in a bond. There are covenants which allow investors to exit once the credit deterioration in a issuer starts. So I think things have massively changed over years. Industry has evolved. If you see that regulations have got much more tighter, where they have put across restrictions on single issuer, they put across restrictions on groups. We maintain a certain percentage of liquid assets, we maintain a certain percentage of AAA assets into the credit fund, and which all facilitates well for the risk reward from a credit risk fund perspective.
Okay.
Coming.
I have to interrupt you, Devang, because we're seeing at the bottom of the screen that there is breaking news. AMFI data, that is the mutual fund inflows and outflows data for the month gone by, that is the month of August, has come through. And it is, at least on the face of it, a pretty picture. You have cumulative inflows to the extent of over 1 lakh crore. And let's delve a little deeper, because I'm looking at the equity category as a whole, actively managed equities, and there's once again a significant inflow to the extent of 38,239 crore rupees. And let's break this down further. I'm looking at sectoral thematic funds, which have once again gotten significant inflows. It has gotten inflows to the extent of 18,117 crore rupees. And is very comfortably now the top category in terms of asset under management in the actively managed space. You have continued to see inflows into mid-cap as well as small-cap mutual fund schemes, over 3,000 crore each. And interestingly, large-cap funds have also gotten considerable inflows, at least when you compare them to recent times. 2,637 crore rupees or thereabouts coming through in the form of large cap inflows in the month gone by. A few of the other mentions, then you have inflows to the extent of 45,170 crore rupees or thereabouts into fixed income mutual fund schemes as a whole. It is mid-quarter, so therefore this is par for the course. And I'm looking at the new fund offers and how much they have contributed, and once again you have 5 sectoral and thematic funds that have been launched in the month of August that have contributed about 10,202 crore rupees in the month gone by, and the subtotal of equity mutual fund schemes that have been launched in the month gone by are 6, and that amounts to about 11,000 crore rupees. So 11,000 crore rupees or thereabouts out of 38,000 crore rupees coming in the form of new fund offers. I'm joined right now by Ashish Somaya, who's the Chief Executive Officer of White Oak Capital. Ashish, thanks so much for taking the time. And more of the same, I think, is what we're seeing in the month of August, and considerable inflows once again into sectoral and thematic funds. Are you at all concerned with the kind of money that is going into these schemes?
Yeah, Alex, I mean, if you look at in net flow terms, I heard you mentioned about new fund launches. And, if you look, further, so like you rightly said, new fund launches, mostly thematic funds, well over 10,000 crores, right? That is one data to look at. And if you look beyond just new fund offers and you look at the business as usual, the total flows, So what you will find if you look at the total flows is that in equity-oriented funds, like you said, some 38,000 crores of net flow. Out of that, nearly half of it is thematic funds. So I think that's kind of not a great thing to really have, if you ask me, because when you look at the thematic funds which are launched and the thematic funds which seem to have collected money, right? So you will find stuff like macro driven. See, when somebody launches a business cycle fund, those kinds of funds are launched when they find that stock picking or bottom up doesn't seem to work and macro themes seem to be working, right? So you've seen a lot of this manufacturing, defense, energy, and then you've seen business cycle, which is also top down macro driven because last 2 years that's how the macro is determined which sectors and which market caps will work. But what happens is that a lot of that is rear view mirror driving, right? And a lot of that money is going into sectors and stocks which have already done their bit. Whereas the reality is that in the last 3 to 6 months, the best performing sector by a mile is probably pharma and healthcare. Right, and I don't think you are seeing any such thematic funds being discussed out there. So yeah, I mean the numbers are great, but the under the hood, the trend or where the money is going from a long-term perspective, not that great.
Yeah, and which is concerning, and hopefully more people are listening to what you're saying when they're making the choices, and take that into account when they make the choices that they are making. What do you make of the inflows into large cap funds? It seems quite interesting, right? Because evidently there is the smart money that is now rotating out of the broader markets and into the large caps because they're a little risk averse. 2,637 crore rupees into actively managed large caps. I haven't looked at many months of data, but I would hazard a guess to say that this is one of the highest that we've seen in quite a while.
It's better than before. It's better than before. But again, when you put it in light with what is happening with thematic funds, and the fact is that on a if you were to look at it, forget just net flow. Even on a gross flow basis, because generally what happens is that when you look at net flow, it hides a lot of things. You should ideally see the gross flow and the outflow. So what you will find is that on a gross inflow basis, small cap and mid cap got more than large cap. And on an outflow basis, small cap lost less than large cap. So what you're finding is that on a net flow basis, still small cap and mid cap and thematic, if you take the pecking order, it is thematic has the highest net flow. Then, it is small cap, mid cap, and, those kinds of things which stack up. And large cap and, large cap, flexi cap, all of that is there. But large cap is like kind of at the bottom when you look at flows, net or gross or whichever way.
Yeah, that's a very important point that you're raising on the gross flow number. I'm also curious, Ashish, about what the SIP number is once again. And I'm also curious about what you have to say, because we've been looking for this data from AMFI for a while about the net SIP flow data, because the contention has been that the gross number, and I've been looking at it since July of 2023, Ashish, the gross number every month has been a new record. So that's great. But there have been closure of SIPs as well. I have been told in the past, look, that's par for the course. And even back when it was 13,000 crore rupees of SIP, anyway, 50% was the net number, 50% or 40%. Is that the way to look at it even now at 23,000 plus crore?
Yes. When you look at 23,000 crore, obviously that's the headline number.
Yeah.
And, different fund houses will have different rate of collection. Say, for example, if there are 100 people who have done 3,000 rupee SIPs, then out of 100, say certain proportion, like say 60-70% might get collected, and say 20-30%, it might get dishonored, or maybe it bounces once and the next time it gets collected, etc. So really, I don't have a number at an industry level in terms of what that proportion is. The second thing is that when you look at net number, so sometimes when people say net, I think there is a confusion which I want to clarify. That there is a stock and there is a flow, right? So in the industry, let us say if you look at equity funds and hybrid funds, the AUM is say 36 lakh crores. Now I'm not counting ETF and index, just counting actively managed equity funds and this balance advantage, etc. Let's say the AUM is about 36-37 lakh crores. out of that you will find that the SIP AUM is, say, maybe about 14-15 lakh crores. Now, because the SIP AUM is 14-15 lakh crores, whose money is it? Is investors' money. When they need the money, they will remove it. Correct. So any which way the industry gets, like if you see this month, there's 90,000 crore of inflow and some 45-50,000 crore of outflow. So the net flow totally in equity and hybrid is about 40-42,000 crores. So when you have 40-45,000 crore of redemption in a month, obviously some of it's investors' money. I mean, it's their prerogative to withdraw when they require. So even in the SIP AUM, people who accumulated over the years, their goals are met. They need money, liquidity, market condition, many things. They might withdraw only. So when you look at net number of SIP, I think you should not be focusing too much on the net number because it's investors' money, they will withdraw. And the point is that redemption is a function of how big your AUM is, whereas inflow is a function of what people are thinking today.
Yeah.
Right. So I think that is the challenge. But yes, I understand your question. Your question was that how much of the 23,000 actually gets collected. I really don't have a number on that.
Yeah.
But safe to say that maybe 60-70% is collected, and at any point in time, some people don't pay this month, they pay next month. These kind of things do happen.
That's a fair point. Ashish, thanks so much for that insight. It's actually quite interesting. Before we actually get the SIP number, and I'm hopeful, fingers crossed, that there's another record to talk about. Thanks so much for joining in.
Yeah, it will be. Yeah.
Thanks so much for joining in. Pleasure. All right. Before we had to interrupt our conversation on because of the AMFI numbers, we were talking about credit risk funds, and hopefully you've been with me since the start of this conversation. We were in conversation with Devang Shah, who's the head of fixed income at Axis Mutual Fund. Devang, once again, we've seen outflows from credit risk funds. This has been something of a trend ever since we've had this issue and this wobble. But having said that, we were talking about potential, and you were saying that there is considerable potential, especially if you go to single A rated papers. I'm actually curious about the landscape right now. Are there issuers in the single A category that are looking interesting? Because I look at your portfolio as of the 31st of July, that's the last one that I looked at, and there's only one, I think, in your portfolio at that point, which accounts for about 2.7 odd% of the NAV. Are there opportunities?
Sure. So, Alex, to answer the question probably more in detail. So, firstly, I think probably you also asked about the timing of credit risk fund, and I'll try to put across that. As you rightly pointed out, I think it is not immediately. We are probably looking at the credit cycle as the next cycle. Today, I think a large part of the AUM in industry is also flowing on to the duration side because the markets are anticipating rate cuts. As I told you, I think today we are in a situation where it makes a lot of sense from a macro perspective, which is falling inflation trend. Your peers, central bankers or developed market central bankers have started cutting rates. And thirdly, if you're looking at the external situation, it's very, very comfortable. So there will be a lot of pressure start to get built up on RBI to cut rates. So for the near term, when I'm talking about next 6 months, I think the duration cycle will be at its play. And investors, accordingly, they want to probably try and benefit out of the ride the interest rate cycle and get some MTM gains. So a large part of the flows are coming into the duration categories. But once the duration play is over, I think again the search for carry and higher yields will start. And because, as I pointed out, the macro environment continues to remain comfortable, we believe that credit risk fund would be the next category where investors will start looking at investment option. From a second question perspective, where you talk about the spectrum and the quantity of issuers, they, thanks to all the disclosures and additional norms which SEBI is coming across on corporate bond side, we have started seeing increase in single A category issuers. In fact, if you look at the last 6 to 12 months, we have gradually built up significant portfolio in AA and below rated assets, and that is increasing day by day. So from a availability perspective, today at the size where the credit risk industry is close to 25,000 odd crores or lesser. We have, I think, the potential to probably take it up to 1 lakh crore for sure from market depth perspective.
Fantastic. Thank you so much, Devang, for joining in. Apologies for the interrupted conversation, but it's been an insightful conversation nonetheless. All right, let's talk about the potential that exists, because Devang clearly believes that there is the potential to take it 4 times what it is currently. Hemant Rustagi, Chief Executive Officer, Wise Invest, and Santosh Joseph, founder of Germinate Investor Services, joining me right now. Hemant as well as Santosh, apologies for keeping you waiting. We were dealing with the AMFI numbers that came through, and once again, an interesting set of data and positive data to say the very least. But we're talking about credit risk funds today, and to that end, has anything changed in your mind? We have continued to see outflows in this category month on month for several months. Hemant, I'll come to you just by dint of experience. You've seen more years than Santosh has.
Well, I think, look, the credit risk fund today, if you look at and how they were a couple of years ago, obviously there's a lot of change. Obviously, the stringent rules that were introduced by the regulator after ILFS episode and a couple of other episodes, obviously will ensure that there is better liquidity. If you see the portfolio of the credit risk funds, the more broad-based, the level of concentration has gone down. The transparency is better because you get to see the coupon rate for each and every security. So in a way, I would say that, yes, they are definitely better in terms of the structure as compared to what they were. But in terms of opportunity, you need to also look at what else is available for you and what is the emerging interest rate scenario. You can't be just looking at only one aspect. Because we know that when you're investing in a portfolio like what you see in credit risk fund, there are attendant risk of investing in that, but also obviously there is a potential of higher return. But that risk still remains, despite the fact that there are a lot of things that have improved. Today, in my view, you are at a time when you're going to see interest rate cut maybe in the next couple of quarters. So in a scenario like this, I believe that there are better opportunities available for investors. Maybe look at dynamic bond fund, maybe look at duration or gilt, rather than looking at credit risk fund at this moment, surely. Because the thing is that, look, there is a universe of 14 credit risk fund right now. The total AUM is roughly around 22,000 crore, and we've seen outflows happening every time. There are two funds, HDFC Credit Risk Fund and ICICI Credit Risk Fund, that account for 65% of the AUM. The total folios in this fund is less than 2 lakh. So, even the risk-taking investors are staying away from these funds. So for me, right now, I don't think it's a great option for investors. There are better options available in the debt space for them to invest for a time horizon of 2 to 3 years.
That's a fair point. Santosh, do you concur? And the last point that Devang made was that now is the opportunity for duration. I think Hemant is speaking about the same thing. But at some point, once the interest rate cycle is turned completely, the opportunity for credit will emerge. Do you concur?
I think so too, because we just spoke about now the industry being about 22, 23,000 crores. Let's go back in time and see just when credit risk were popular as a category. That segment was well over 1.5 lakh crores in the credit risk category alone. Those bonds, if I were to take the net sum in other funds that were present, as maybe almost a 2 lakh crore industry. Today, it's come down to 1/10 its size. And today people are scared because of the recency bias of the 1 or 2 episodes we've had. But the fact remains that globally, junk bonds or credit risk bonds, or however different names that we call it, are an interesting part of asset allocation in client's portfolio. I agree it's not for every investor. I agree it's not for the one that's looking for stable, safe investments within the fixed income portfolio. But one cannot always say, I will not look at this, especially when you have today such transparency, clarity as far as the portfolios are concerned. I think the point that we need to take home is that the industry today, as far as the liquidity for credit risk is concerned, is way different, way better, way more robust than what it was in the previous avatar. So therefore, credit risks should be considered for the set of investors who are willing to bet for high risk, high return within the fixed income sphere. And I think that will lead to automatically more and more interest, and more interest will lead to more and more growth of the credit risk as a space. But I think one cannot rule it out. All the facts that we spoke about, a softening interest rate regime, better ecosystem is good. But also don't forget, equity markets at an all-time high. There will be some thought at some level to rebalance your fixed income equity portfolio. Within that, book some profits from equity and put it into fixed income, and there, instead of taking the high risk of equity, you may take slightly better risk in fixed income to get a better yield. End of the day, everything boils down to net yield.
Yeah, that's a fair point. Just Hemant, a quick view on the two funds that you mentioned. Or are there at all any schemes that you like, or would you? Is it a blanket avoid for you? And then I'll come, Santosh, quickly to you on your view.
No, Alex, it's not a blanket avoid. The thing is that risk profile of investor has to be very different. I mean, you need to have, the risk appetite to invest in such a portfolio. I mentioned about two funds. I think if someone has to look at funds which have done consistently better compared to maybe others, these are the two funds that I mentioned that one can look at. But again, like I said, we were just discussing the industry numbers that we're talking about. Money coming into sector and thematic fund and mid and small cap fund. Problem is that, when a particular fund is doing well, a particular category is doing well, investors kind of tend to forget what is the risk profile, what is their risk profile, and what is the risk profile of investor. I think that's something every investor need to look at. So I'm not saying blanket avoid. You need to be very, very careful when you're looking at such a fund.
Santosh, last 20 seconds. Sorry to cut the time, but do you like any schemes in this category, and what's the strategy? How much should you allocate?
Frankly, we got exposure to both the funds. The reason is we like credit risk. We have gone with the two best and the biggest because I think one factor that we don't kind of allude to more often is a liquidity requirement. And there is a general consensus that large AMCs with large OEMs and better infrastructure in place will be able to manage liquidity events. So therefore, I blanket won't write off credit risk fund. I think if you're able to look at the portfolio, look at the asset liability match or mismatch that is in the portfolio, and I think the investor understands the risk one is taking. I think whether the two that we just spoke about or even the ones, as long as the portfolio is good, you can invest.
Which two are you talking about?
HDFC and ICICI.
Okay, fair point. Just wanted to put the names out there. Thanks so much, gentlemen, for taking the time. Pleasure speaking with you, and apologies for a curtailed conversation, but it was insightful nonetheless. That brings us to the end of this particular edition of the Mutual Fund Show. It's been a pleasure bringing it to you. Do stay tuned. Lots more coming up on NDTV Profit.